Hi guys, welcome to the channel. My name's Matt and I'm a UK based financial advisor. In this video we're going to be talking about restricted stock units. We'll cover what they are, how they work, how they're taxed and whether you should sell them or not. Restricted stock units, commonly known as RSUs, are a form of employee compensation in addition to other compensation an employee might receive, such as a salary or a bonus. RSUs are a way an employer can give its employees shares of the company they work at to reward them and to motivate them to stay working at the company. They're really popular in US tech firms. We're seeing the likes of Google, Facebook and IBM giving them out to their staff, but we're also seeing more UK staff working for these US firms receive RSUs as well. So, how do they work? There's two key dates to remember with your RSUs. First one is your grant date, second one is your vest date. The grant date is when your RSUs are awarded to you. This may be when you first join the company or they're awarded on an annual basis. The vest date is when you have access to the RSUs and therefore you have the option to sell them. So, once RSUs are granted, they typically vest over a period of a few months or years, and this is known as the vesting schedule. This is to ensure that the employee doesn't receive all the RSUs in one go, leave the company and go work elsewhere. So let's have a look at a couple of examples. We've got Rachel, who works for a software company. She started there in April 2023, and at the beginning of her employment, she was awarded 10,000 RSUs. After 6 months, so in October 2023, 2,500 of Rachel's RSUs will vest. Then every quarter after October 2023, 625 of her RSUs will vest. So for Rachel to receive all the RSUs granted at the beginning of her employment with the company, she'll have to stay working there until October 2026. Another example is Jake. Jake works for an engineering company and started work there in April 2023 as well. As a part of his compensation, he's been granted 1,000 RSUs at the start of his employment, but every year after he will be granted a further tranche of 1,000 RSUs. Jake's vesting schedule is as follows. So 250 of Jake's RSUs from each tranche will vest each year in the following 4 subsequent years. So let's break this down. Of his initial 1,000 RSUs, 250 will vest in year 1, 250 will vest in year 2, and so on until that initial tranche has been fully vested by year 4. Now, because Jake is receiving additional RSUs each year, he works at the company, he will have years that contain multiple vesting periods. So, how are these RSUs taxed? The 3 tax considerations to be aware of with RSUs are income tax, national insurance contributions, and capital gains tax. RSUs are not immediately taxed as income when they are granted to an employee. Instead, the RSUs are taxed when they are vested, so when you have access to them. The value of the shares at vesting is treated in a similar way to how a salary would be taxed. So they're subject to income tax and employee national insurance contributions. However, unlike a salary, you may have to pay employer national insurance contributions as well. This is at the discretion of the company you work at, and often the company will cover it, other times they will pass this on to the employee. So let's have a look at an example where an employee earns £70,000 as a salary and has £20,000 of RSUs being vested. In this example, the employer national insurance contribution is at the liability of the employee, and based on current rates of 13.8%, this leaves a remaining amount of £17,240. Of this remaining amount, income tax is applied, and as the employee is on £70,000, their marginal rate is 40%. And finally, employee national insurance contributions are applied at 2%. So from the initial £20,000, after all national insurance contributions and taxes, £9,944 is what is left over, which is an effective tax rate of 50.28%. Let's have a look at another example where the employee earns £100,000 as a salary and again has RSUs worth £20,000 being vested. So, similar to before, the employee is liable for the employer national insurance contribution, leaving £17,240 left over. However, the income tax differs here. As the employee earns £100,000, they're about to fall into what is known as the 60% tax trap. This is where for every £2 you earn over £100,000, your personal allowance is reduced by £1. So if you earn £125,140, your personal allowance is fully reduced. So in this situation, the employee is paying 40% tax on the RSU earnings, plus they are losing the majority of their personal allowance that was previously tax-free, thus paying an additional 20% tax on that income, resulting in an income tax rate of 60% for those RSUs. Again, employee national insurance contributions are applied. So from £20,000, the take-home value of the RSUs after all national insurance contributions and taxes is £6,496, which is an effective tax rate of 67.52%. Hefty. Often what happens is the company will sell enough shares to cover all these taxes on your behalf, and you'll be left with the remaining amount. So let's look at capital gains tax. The capital gain used on RSUs to assess whether you pay tax is the difference between the value when they are vested and the value when they are sold. If you sell the RSUs as soon as they're vested, then you will not pay any capital gains tax, as in theory there'd be no gain made during this period. If you do decide to hold on to the RSUs once they're vested, then whether you pay capital gains tax or not will depend on how big the gain is. Now remember, you do have your capital gains allowance for the 2023-24 tax year. This is £6,000 for individuals. For the 24-25 tax year and any tax years onwards, it is being reduced to £3,000. If your gain exceeds your allowance or you've used your allowance elsewhere, then capital gains tax is 20% for high rate taxpayers and 10% for basic rate taxpayers. So, is there a way you can reduce any of these taxes? Now, one effective way of reducing the amount of tax you pay on RSUs is by making contributions to your pension. Pension contributions provide income tax relief, and this tax relief is based on the highest rate of income tax you pay. So let's have a look at the example of the employee who's on a £100,000 salary. Here is the tax I showed earlier where there is no additional pension contributions made, and I've made a comparison where the employee makes an additional £20,000 pension contribution. By making this pension contribution, it brings the employee's adjusted net income back to £100,000, therefore fully reinstates their personal allowance, meaning that they've not fallen into the 60% tax trap, which then means their effective tax rate on RSUs is then reduced to 50.28%. Now, with pensions, there are rules on when you can access them. Currently, this is 55 and it is moving to 57 in April 2028. And income tax is applied when taking income from a pension. I won't go into the rules about this now, but it's something to be aware of. So, once your RSUs have vested, should you sell them immediately? And in the majority of cases, the answer is yes, and this is for two reasons. Reason number one is you will not have to pay any capital gains tax if you sell them right away. The proceeds can then be reinvested in a tax wrapper that does not have capital gains tax applied. This could be the pension I talked about earlier, or it could be an ISA. Reason number two is by not selling your RSUs, you are potentially holding a large portion of your investments in one individual company. If your employer stock underperforms, then you could be heavily exposed to this. But you can reduce this risk by selling the RSUs and reinvesting the proceeds into a portfolio that holds a variety of different investments. Another important question is, can you keep the RSUs after leaving a company? Now, this depends on whether the RSUs have fully vested or if they've only been granted but yet to vest. If the RSUs have already vested and converted into shares before you leave the company, then you own these shares outright and your departure from the company has no effect on them. If you leave your job with unvested RSUs, you will most likely forfeit your right to those RSUs as company shares. Keep in mind your employer commits to release the RSUs only if you remain with them for a specific amount of time, and it's only reasonable that you give up your claim to these shares if you don't stay around for the full vesting schedule. It's really important to know your vesting schedule so you know how many of your RSUs will vest and when. You do not want to miss out on any shares you may have coming up by leaving your employer just before your RSUs are about to vest. So that is an overview of RSUs and how they work in the UK. If you have any comments or questions, please write them down below. Or if you want some advice on what to do with your RSUs, then click on the link below for a free consultation call.